Can the rally continue? That is the question. So let's bring in, unless you had something else to say.
No, let's bring him in.
Great. Seth Denson, co-founder and chief strategist at GDP Advisors. Seth, great to have you here with us today. Consumers continue to be strong. The rally continues. The economy is holding strong. How much longer can this rally last?
Well, listen, I think that if I was able to predict that with absolute certainty, I'd probably be on a beach somewhere, right? I mean, I think that as far as this rally as it's running today is concerned, we're all exceeding really everyone's expectations, I think. So I'm excited going into the new year. I think we close out the year over the next 2 days pretty strong, and next year is we're going into very optimistically, although I would say cautiously, to recognize that there's an end to this at some point.
Yeah, the S&P 500 right now, closing the day just barely higher, 3239. And here's why that's so important as well. As you know, Seth, many of the big banks out there, investment firms, they are calling for the S&P 500 to end 2020 at 3,300, which is really simple math, just about 60 points off from here. And so what does this call for in 2020? Slow, extremely slow growth, a return to normalization, or are we looking at heavy volatility, which ultimately nets us just barely off of, but to the upside, the same place that we're in right now?
Yeah, I'm not one that thinks that we're going to see a ton of volatility in the market, although I do expect that we're going to see a slowdown. I think that anybody that's thinking that we're going to maintain this bullish market like we've had thus far, I mean, think about it. The S&P is up, nearly 30% for the year. The Dow up 22%. I mean, this is beyond everybody's expectation. So I think to think that we're going to repeat that in 2020 is probably a bit naive, but I'm excited to see that labor market's still good, joblessness is down, consumer confidence is at all-time high. We've got positive things going on here at the end of the year.
But particularly if we're looking at the markets this year, yes, if you take this on a calendar basis, it's been an amazing year to watch. But if you take the third quarter of 2018 out of the equation, kind of sans all the volatility that we saw that ultimately netted us in perhaps the worst position to begin the year this year, we really dug ourselves out of a hole, and that's just what we watched, especially on the back of a Fed that was willing to ease rates, on the back of a market that was really dependent upon positive movement in the U.S. and China trade front. We got both of those. And then as the kicker, you've also got USMCA finally going through. So trade and the Fed, all of those coming together, and then the economic data still showing strong. Should we be looking at this from a calendar year perspective? What is the best accurate way to look back at 2019?
Well, listen, I think the way that we're looking at it from a calendar year is probably the best way, just from a perspective of that's the way we tend to look at things. And I think if we start to interject new ways of addressing the markets, we tend to find ourselves kind of playing to our own unnecessary volatility. So I think we do need to look at this from a calendar basis. I think that we will look at 2020 from a calendar year basis as we move forward. So I'm a big believer in that history repeats itself. So let's learn from it. Let's be cautious of what we know is coming, which is an end to this bullish rally. But let's not get overly emotional or drastic in our movements.
Yeah, Brad brought up the idea of trade. We are, still waiting for that finalization of the Phase 1 trade deal. It's being translated at this point. The final details are being worked out. But how do we reconcile this idea that for the past few months, any incremental movement on trade moved markets pretty significantly that day or in that moment? We haven't gotten any real updates on trade since that Phase 1 was announced. Why are investors still so optimistic, even though we haven't had any maybe progress on trade outside from that Phase 1 of the deal?
Well, I think, you brought up the third quarter of 2018, and that's really into December when we saw that volatility from last year, and that was really when this whole trade thing came to the forefront. And throughout the year, we've seen the markets move almost erratically based on tweets or comments from either China or the president. And so I think that the markets had priced in a Phase 1 deal. We are now from both sides hearing that there is a Phase 1 deal. Obviously, the details have yet to really come out of that. But I think that there's optimism going into the new year. The other thing that I think is on investors' mind is that we're in election season. And politics play a big role in what deals may or may not happen. And I think that investors are fairly confident that the president probably doesn't want to have his legs knocked out from under him by not getting something done with China going forward.
And so for the president right now, the biggest priority in terms of the next phase of the U.S.-China trade deal, what do you think that is?
Well, listen, I don't want to speculate too much until we know what's in phase one, right? I mean, I'm anxious to see what is all in this deal. I still firmly believe we're intellectual property. That's something China's been taking advantage of for far too long. At the end of the day, this trade war, we've overcome it, and the president has stood strong against some pretty insurmountable odds here, and I think that he'll benefit from that so long as we keep moving the needle forward.
Part of this end-of-year rally can be partially attributed to strong retail sales, strong holiday sales overall. Why are we continuing to see the consumer be so strong, even amid tariffs, even amid uncertainty around trade and the trade war?
Yeah, well, listen, I think that the consumer is recognizing that, the overall economy is good. And you've got a lot of things playing into that, including joblessness, right? Wages are moving up. People have got good jobs. I speak to employers all the time. It's what we do. And we consult with CEOs all the time who are constantly telling us that they're looking for ways to pay people more and give better benefits and increase value to their employees to get quality people. So I think that's playing into the role of where the consumers are today, in that there's optimism all around.
If you were to look forward and give a theme, or at least a projected theme, to 2020, what would that be, Seth?
Yeah, don't overreact. I think, listen, there's an old saying, right, that if you're in a bear attack, play dead, don't move, right? And I think that it's likely we'll start to see us come off of this bullish market some. Don't get emotional about it. Right? Especially for people that are maybe around our age who have a lot more time in the market. Let's be calm and play the long-term game here. And for those that are in a shorter window in the market, they probably should start looking at diversifying out a little bit and making sure they're not in things that may be requiring a bullish market going forward.
All right. Still trying to figure out what our age is right now. But hey, we'll just say we're unicorns and call it a day. Seth Denson, who's the co-founder and chief strategist at GDP Advisors. Thanks so much for joining us.
Happy New Year to you.
Happy New Year.
To you.